Welcome to my channel. I'm Scott, and in this video we're going to cover 5 airline stocks. The first company we're going to look at is JetBlue, then Copa, Allegiant, Spirit, and Frontier. The airline industry offers air transportation and travel services for individuals and cargo. Some of the main services offered are flight transport, aircraft leasing, hotel booking, and car rentals. As the surge of COVID-19 has subsided, many airlines have seen bookings grow at a fast pace. Unfortunately, the price of jet fuel has surged recently following Russia's invasion of Ukraine. The increase of oil prices may hurt the margins for the airline industry. There are some companies that fly all over the world. Some companies just fly within a specific country, and others that fly within a specific region of a country. Let's get started with the model. The first company we're going to look at is JetBlue. Their latest financials are 331. And this is a mid-cap company, 3.3 billion market cap. They're trading at $10.19 a share, and they have 321 million shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. They did have a big negative in 2020 due to COVID, but the other years they did have positive free cash flow. Free cash flow is the cash that's remaining for you, the investor, so a company can pay a dividend, buy back stock, pay down debt, or invest back into the business to grow it. Net income is the profit or loss on the income statement. It's revenue minus expenses. That was positive in 2019, negative in the other years. Revenue is a sales for the company, and that's down 13% from 8 billion down to 7 billion. But it has been growing a lot from 2020. It was 3 billion, it doubled to 6 billion. Now it's 7 billion in the trailing 12 months. The weighted average cost of capital is an important number in a DCF model. Finbox's range is 9.3% to 10.8%. I'm going to use the middle number of 10%. And that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's 13 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $11 billion. We divide that by 321 million shares. And we get a calculated stock price of $35. They're trading at $10, so they're trading at a 71% discount. It's a buy according to the model. The company's revenue target for 2024 is 10.5 billion. For 2023, it's 9.8 billion. And for 2022, it's 8.9 billion. And I continue that growth into 2025, and I got 11.2 billion. That's how I got their future revenue estimates. And the company converts on average 8% of their revenue into free cash flow, so I multiplied their future revenue estimates by 8%. That's how I got their future free cash flows. The website Simply Wall Street's valuation is 76. They're saying the stock is 87% undervalued. 11 analysts priced this stock, and the average price target is 15, the low is 12, the high is 22. This is where the stock has been trading the last 5 years. So it was trading over $23 a share. Then once COVID hit, it dropped to around $8. Then it jumped way back up to over 20, but it's been cut in half since then. It's sitting around $10 today. The next company we're going to look at is Copa. This is a mid-cap company, 2.9 billion market cap. They're trading at $69 a share, and they have 42 million shares outstanding. Their free cash flow is similar to JetBlue, negative in 2020, positive in the other years. Net income is also negative in 2020, positive in the other years. Their revenue is down 30% from 2019 to the trailing 12 months, but it almost doubled from 2020 to 2021. Then grew almost 400 million to the trailing 12 months. Their WACC on Finbox ranges from 9% to 10.8%. I use the middle of 10%, and that's the discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's 6.6 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $5.5 billion. We divide that by 42 million shares. And we get a calculated stock price of $132. They're trading at 69, so they're trading at a 48% discount. It's a buy according to the model. Their revenue target for 2024 is $3.3 billion. For 2023, it's $3 billion. And for 2022, it's $2.6 billion. And I forecasted their 2025 revenue to be $3.6 billion. That's how I got their future revenue estimates. They convert on average 13% of their revenue into free cash flow, so I multiplied their future revenue estimates by 13%. That's how I got their future free cash flows. Simply Wall Street's valuation is 47. They're saying the stock is 46% overvalued. 5 analysts priced this stock and the average price target is 104. The low is 88, the high is 132. This is where the stock has been trading the last 5 years. It was close to $150 back in 2018. Then it dropped to as low as $30 when COVID hit. It came up to about $85, $90 at the peak, but now it's back down to below 70. The third company we're going to look at is Allegiant. This is a mid-cap company, 2.6 billion market cap. They're trading at $146 a share, and they have 18 million shares outstanding. Their free cash flow was negative in 2019 and 2020, but positive in 2021 and the trailing 12 months. Net income was only negative in 2020, positive in the other years. Their revenue is actually up from 2019. It's up 5%. This is one of the few airlines that has recovered this quickly. And their revenue almost doubled from 2020 to the trailing 12 months. Their WACC on Finbox ranges from 7.8% to 9.3%. I use the middle of 8.5%. And that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's $5.5 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $4.8 billion. We divide that by 18 million shares. And we get a calculated stock price of $267. They're trading at $146, so they're trading at a 45% discount. It's a buy according to the model. Their revenue target in 2024 is $3 billion. In 2023, it's $2.7 billion. In 2022, it's $2.3 billion. And my forecast for 2025 is $3.5 billion. That's how I got their future revenue estimates. They convert on average 9% of their revenue into free cash flow, so I multiplied their future revenue estimates by 9%. That's how I got their future free cash flows. Simply Wall Street's only at $16. They're saying the stock is 800% overvalued. 4 analysts priced this stock and the average price target is 208. The low is 175, the high is 250. This is where the stock has been trading the last 5 years. During COVID, it bottomed out at 60, then shot way up to over $250 a share. But it's come down about 40% since then. It's sitting around 140. This is the only airline we looked at where the price after COVID was higher than any of the prices before COVID. The fourth company we're going to look at is Spirit. This is a mid-cap company, 2.1 billion market cap. They're trading at $19 a share and they have 109 million shares outstanding. They only have positive free cash flow and positive net income in 2019. Their revenue is only down 2% from 2019 to the trailing 12 months. Their WACC ranges from 10.3% to 12.3%. I use the middle one of 11.3%, and that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's $4.7 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $3.7 billion. We divide that by 109 million shares. And we get a calculated stock price of $34. They're trading at $19, so they're trading at a 44% discount. It's a buy according to the model. Their 2024 revenue target is $6.7 billion. 2023 is $5.9 billion, and 2022 is $5 billion. And I forecasted 2025 of $7.5 billion. That's how I got their future revenue estimates. In 2019, they convert 5% of their revenue into free cash flow, so I multiplied their future revenue estimates by 5%. That's how I got their future free cash flows. And I assumed they would have negative free cash flow in 2022, since they have negative in the trailing 12 months. Simply Wall Street's valuation is 64. They're saying the stock is 70% undervalued. 5 analysts priced this stock and the average price target is 25. The low is 22, the high is 29. This is where the stock has been trading the last 5 years. It was over $60 back in 2019. Then it fell below $10 during COVID. It came back up to about 40, but the price has been more than cut in half since then, sitting below $20. The last company we're going to look at is Frontier. This is a mid-cap company, $2 billion market cap. They're trading at $9.38 a share, and they have 218 million shares outstanding. Their free cash flow looks pretty good, only negative in 2020. Net income is positive in 2019, negative in the other years. Their revenue is only down 5% from 2019 to the trailing 12 months. Their WACC on Finbox ranges from 8.3% to 9.5%. I use the middle of 9%, and that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's $2.9 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $2.6 billion. We divide that by 218 million shares. And we get a calculated stock price of $12. They're trading at $9, so they're trading at a 21% discount. It's a buy according to the model. Their revenue target in 2024 is $4.4 billion. In 2023, it's $4 billion. In 2022, it's $3.3 billion. And my forecast for 2025 is $4.8 billion. That's how I got their future revenue estimates. They convert on average 4% of their revenue into free cash flow, so I multiplied their future revenue estimates by 4%. That's how I got their future free cash flows. 5 analysts priced this stock and the average price target is 18, the low is 13, the high is 20. This is where the stock has been trading since it IPO'd in the beginning of 2021. They picked a bad time to start trading because the market hasn't done that well. The stock has only gone down since it came out. It's down about 50% from the IPO price. Here's a chart of all 5 stocks where they've been trading the past 5 years. Allegiant is the only one that's up. It's up 3% in the past 5 years. Copa is down 36%. JetBlue is down 52%. Spirit and Frontier are down the most, 65 to 68%. There are 22 companies in the airline industry, and here's a list of the 5 we looked at. The average CapEx spend is $757 million. JetBlue spends more than average, the other 4 spend less. Frontier has the worst debt to equity ratio, 6.8. That means for every dollar of equity, they have $6.80 of debt. The other 4 are below average. JetBlue, Copa, and Allegiant generate more free cash flow than average. Spirit is negative, and Frontier is really low. All 5 companies have a market cap below average. The average is $7 billion. All 5 companies have a better than average price to book ratio. Copa and Allegiant have good price to earnings. The other 3 companies have negative earnings, so we can't look at their PE. JetBlue has an amazing price to free cash flow. Allegiant and Copa are also pretty good as well. Spirit has negative free cash flow, so we can't look at that. And Frontier has a pretty weak ratio. JetBlue has the best price to sales. Copa has the worst. JetBlue generates the most revenue. Copa the least. And Copa's 3-year annual revenue growth rate is negative 17%. Spirit and Allegiant are positive. JetBlue has a small negative, and Frontier has a small negative. So to summarize, all 5 companies appear undervalued according to my model. Same thing with the analyst price targets, all seem undervalued. Simply Wall Street has Allegiant overvalued, JetBlue, Copa, and Spirit undervalued, and they do not have a price target for Frontier. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.